Welcome back, everybody, to Keys and Gears. This is Bess Dickson, a local Texas real estate pro, and I'm Mark Liesner. We're teamed together a lot of times on transactions. I'm a mortgage pro here in Texas. Together, we have, 40 plus years of experience in the real estate world. So today, we're going to talk about down payments. I know a lot of people have questions about down payments. You know, how much do I need? But they also have questions about closing costs. That's going to be a separate episode, okay? So there's two parts to the money that you bring to get those shiny keys. One is your down payment. One is the closing costs. Those are two separate things, right? So today we're only talking about down payment, all right? So tune in for next time.
And down payment, to just get it down to kindergarten level.
Yes, please.
Is the money that you are responsible for to bring to Keys Day, closing day, and that percentage that we're getting ready to dive into is the percentage of the purchase price.
Right.
The percentage of the purchase price.
Correct.
That you're going to be required to bring.
That's right. It's based on the purchase price, okay? So down payments, they can come from many different sources. There's also many different percentages out there, okay? For a time, there were actually lenders who were offering 1% down payment, and they were giving you a 2% grant at closing for the remaining to make up 3%. 3% is really the lowest down payment you can find out there, and that is what's called a conventional loan. You can do 3% down if you're a first-time home buyer and it's your primary residence.
Time out?
Yeah.
Define first-time home buyer. Can't you have already bought a house before and still be called a first-time home buyer?
Yes. I wish we had the ability to have like a quick little sidebar competition of who can answer this question, and we'll give you a prize at the end. But we don't have that. It's unfortunately not possible. So the quick answer is you can be a first-time home buyer even if you've owned a house before.
Ding, ding, ding.
So if you haven't owned a house in the last 3+ years, you probably can qualify again as a first-time home buyer. So, but
why does that matter? Because percentages matter when you're buying
the down
a house.
payment matters. It matters in the down payment arena more than anything else. The one thing I would like to caution is that's where I was headed with the 3% down payment. If that is all you can bring to the table, my next question to you is, how much do you have in reserves after closing? So after you subtract out of your bank account the down payment and your closing costs, how much do you have left over? Because what I want to avoid is a situation where you buy a house and you're penniless, and a week after you buy the house, you need a new water heater. It's going to cost you $1,500 to install. And now you're up, what creek. And
I've heard that's a good show.
Yeah, I know. It's a funny show. In this case, it wouldn't be funny. But so that's my question to you is, why are you putting 3% down? Okay. So I just want you to go in eyes wide open. All right. FHA, which is a federal housing authority, they allow you to do 3.5% down. With any down payment that's less than 20%, you're going to incur mortgage insurance of some kind, okay? The only exception to that is the veterans out there. If you want to do a VA loan, that's different, right?
That's also 0%.
You can do a 0% down on a VA. A lot of times I don't recommend doing it, but for financial reasons, I don't recommend it. If you have money to throw at, I hate paying interest. So the more money you throw at it, the better, because you pay less interest over time. Makes sense? Your bank balance, your loan balance is lower, therefore you're paying less in interest over time because it adds up. Guess what? It's not free money. So with that having said, the mortgage insurance changes. The FHA mortgage insurance is different than the conventional mortgage insurance. So a 3% down conventional loan has different mortgage insurance rates on it than an FHA 3.5% down, because that's the minimum down payment for an FHA loan. They're two separate, different calculations. One is based more on the credit score. Your conventional loan is based on the higher your credit score, the less you pay in mortgage insurance. It's also paid, obviously if you put more money down, the number goes down as well. The FHA is more based on the loan amount than the score, than the actual score. So, and that's, by the way, how these FHA loans are insured by the FHA. They are insuring the lender who actually gives the money. The FHA, Federal Housing, insures that loan, and they insure that by you, the buyer, paying that mortgage insurance. So that pays them into a fund. But there's also an upfront fee that you pay into that mortgage insurance fund that they have, and that fee is financed. So it gets added to your loan amount. Okay.
All right, so let's time out. Let's do a
It's
gear
a lot
shift.
of technical things
Let's
here.
do a gear shift, numbers
yes.
man. You've gone as far as my
Your brain's going.
as my brain. I don't know if I go. Okay. All right. So essentially, if you are less than what anyone has told you of 20%, if you go below 20%, then you are guaranteeing yourself an additional expense, an additional cost on top of the standard mortgage payment.
Correct.
Which is mortgage is actually
Principal,
principal,
interest,
taxes, and
and
insurance,
home insurance.
and now you're adding another I, if you choose to go below 20% of private mortgage insurance.
Correct. Or any kind of mortgage insurance, FHA or private
whatever
mortgage
it is,
insurance.
right,
Private
okay.
mortgage insurance is for conventional.
Okay, so y'all got that?
Right.
You on board with me? Okay. Now, so the advantage of 3% conventional or 3.5% FHA if you are a first-time home buyer, or second-time buyer, 5% conventional.
Yep.
Right.
5%
Although
down.
many second-time home buyers, per your thought on the interest, do choose to do 10%. And there's another reason why for that as well. We can talk about in a minute.
We'll get to that.
We'll get to that. Okay, so let's get some real live numbers with that. If we are buying, let's go simple numbers. If we're buying a $500,000 house, that's what we want to do to be in our neighborhood and the schools or whatever it might be, and it's 3% down conventional. How many dollars is that actually?
That's $15,000.
$15,000. All right. See, I could do that math, but he's the numbers guy, so I'll let him do that math.
Oh,
So,
I use a calculator, honey.
so 15,000.
Yes.
All right, would be the amount that's
minimum.
going to leave your savings account, your home savings account, and be deposited with the title company.
Correct.
On closing keys day.
And will be given to the lender.
Okay, and the private mortgage insurance that we're talking about is going to it does not show up on closing day. It shows up later as
your
part of
monthly
your
payment.
monthly mortgage
Correct.
payment. I just wanted to get those numbers
Correct.
straight and the down payment straight with y'all.
And the reason mortgage insurance, to give you an idea, mortgage insurance are a separate company that insures the lender who actually gave you the majority of the money against you, the buyer, defaulting on that loan.
Mm-hmm.
You not making payment. If that was the case, if it went into foreclosure, that insurance company now has to pay the lender the amount that's left on your mortgage.
So Bess's Hot Sports opinion, I have to jump in here on
Yes.
this, and that is, I don't know about you, but I think insurance is the wrong name for this. I think it's really should be called a tax, a mortgage tax. Why is that? Because insurance, you and I, when we pay for car insurance or other insurance, it's to insure our persons from a surprise emergency that puts us in trouble, like to try to get us back to right after a surprise hiccup in life, speed bump.
Right.
We're keys and gears, speed bump, not hiccup.
Yeah,
Okay.
yeah.
All right. This private mortgage insurance, it only goes, did you hear what Mark said? It only goes to protect the lender. It doesn't protect you at all. It does not mean that if you have a surprise in life, that someone is going to graciously pay for your mortgage so you're not hungry and homeless overnight. No,
Right.
It doesn't work that way. Okay, this private mortgage insurance is strictly to protect the business of lending.
But I take your point. I accept that point. However, you have to remember, if somebody's handing over to you $500,000 and you didn't put 20% down, that makes you more risky. And if I was handing somebody $500,000, I don't know about you, but I'd love some insurance against Bess not making the
More
payment.
skin
Because she said,
in
take
the
my word for it, I can
game.
make the payments, and then she doesn't, and then I'm out
No.
$500,000. So
Right.
there is you're
I went
getting
on that vacation instead of
you
paying my mortgage.
you are
Yeah.
getting a benefit as a buyer, because here's the point I'm going to get to about the lower down payment and why would you do a lower than 20% down payment. Okay, it's because if you are using money as a down payment and closing costs that is coming out of investments, where that money are you pulling away from things that are making you money, then the calculation has to be, if I pull that money out of this investment that's currently netting me 15% return a year,
Even 8%. That's still more than.
is it worth taking that money away and not getting that return and putting it into a house and incurring that mortgage insurance? Because here's the thing about mortgage insurance. FHA is the exception. FHA never, that mortgage insurance never drops off until you sell the house or you refinance into a conventional loan. The conventional mortgage insurance does drop off, and it has to do with the appreciation in the neighborhood. So in many cases, in Dallas at least, you're talking about a 2 to 3 year span of you paying that mortgage insurance.
Brilliant home hack.
And at that point, the house has appreciated to the level where the lender now says, we don't need that insurance anymore because
not as
there's enough
risky.
equity in the house that if you got in trouble, we could sell that house and make our money back. Okay, so in a lot of cases, it's, some of my wealthy clients, they are adamant about putting 20% down until I say to them, where's that money coming from? And then I explain to them the math behind. It may not make sense to pull that money out and put 20% down. Instead, go with the 5% and then make extra payments towards the principal amount of that mortgage in the future. Because here's the second hack that comes into play with mortgage insurance. It's counterintuitive, but it makes sense after I explain it to you. Your interest rate most of the time will be 1/8 of a percentage point lower with mortgage insurance than without it. So a 20% down payment person has a higher interest rate than somebody with 5% down. Why is that? It's risk. The lender with that mortgage insurance is insured against your default, makes you less risky. I know that's a kind of a mind, what.
That is a secret home hack that no one likes to talk about.
Right.
But you heard it here first. No.
And an 1/8 of a point difference, if you kept that mortgage for 30 years, makes a huge difference, especially at our current home prices. And guess what? You're going to be at that lower interest rate once that mortgage insurance drops off, and you have saved money
And
that
let's
way.
put a number on that homeowner's insurance. It's around, think of a 30,000 level view. Isn't it around $100 a month?
No, there's no rhyme or reason because it's dependent on your credit score.
Fair enough.
So there's no real.
The ones I have seen on my
Well,
it's been around $100. And so just
and the loan
to give
amount,
numbers,
too.
we keep talking about these
Right.
generalities. Think about it. So for $1,200, $100 a month times 12,
Yeah.
right? $1,200. You put down 5%, okay? 5% plus over the course of 12 months, another $1,200, right? And in exchange for that $1,200, the other 15% of that 20 gets to stay over here
And make you
8, 11, 12, 15% return.
Right. It's really.
See? That's a good exchange rate, I think.
Yeah.
$1,200 in order to have 15% make way more than $1,200. Generally.
And I should have mentioned that in the opening, but a lot of people get held back from buying a house because they're worried they don't have enough of a down payment, right? So again, the conversation with you, if you have 3% saved up, how much extra can you save up after that or in the meantime, so that you're ready for any kind of oopsies that happen after you own a house? It still may be the right thing for you to do. It's just you got to have additional. You got to put some more thought into what happens after the fact. Now I've got shiny keys, I'm living in my new house, now what? I'm penniless and I can't afford this house, right? And so with less than 20% down, then I look at their bank accounts, and we have a conversation about what is this looking like? Why are you doing, this, and why and this is where I get in trouble with the realtors, because sometimes I recommend a lower price point home versus stretching their budget, because they just don't have the wherewithal. And as a realtor, the good realtors will say, absolutely, I don't want you to be
great.
penniless.
Yes.
I don't want you to call me in a year from now saying, oh my God, it's going to go into foreclosure unless you sell it for me best.
Yeah.
We've all had those phone calls, right? So down payment there's a lot more wrapped up in down payment than what we've gone over, but that's kind of the basics. So the more money you put down, you're squeezing a balloon, the less you pay in interest. But if you put less money down and have your money working for you, you're going to end up making probably more money
Higher
than you
return,
pay.
essentially.
Higher return.
Yeah.
Next question is, how long are you going to live there, right? How long are you really realistically going to live in this house? Let's add up the interest you're paying during the next 5 years, and then look at how does that relate to the money you're making
Right.
on your
And
down
to
payment.
review what you were saying, there are ways to mitigate that interest outside of just putting down a big chunk of money.
Right.
It is, you mentioned it quickly, but paying
Extra
extra.
towards your principal, paying
even
down
if
the
it's
loan
just
balance.
rounding it up. If your monthly mortgage is $255, wait, I wish $255, but if let's say $22.50 and you round it to $3,000,
Right.
and you mark that difference, that $750 difference to principal. I mean, was it you shave off like 7 years or something?
Yeah.
I mean, it's like it's crazy how quickly it can go.
And that's where you save the interest, because you're paying the investor less money over time, because you've shortened the time of you paying that mortgage.
In the meantime, by putting down less money to review and leaving that other 15% working for you, you're making that money.
Yeah.
And then the third little piece, talking about private mortgage insurance again, and Mark hinted at that as well. Great home hack is, especially in some neighborhoods here in Dallas, within 2 years, the house itself, the value of the house itself will make up the difference between the 5 or 10% you put down
And the 20.
and the 20%, because it doesn't have to just be dollars. I guess that's it succinctly.
Right.
That 20% does not have to be actual dollars. It could be
Appreciation.
value.
Unrealized dollars, yes, as they would say in the investment world.
So that plus that can equal your 20, and then that PMI drops.
Yeah.
And in the meantime, again, that 15% has been making you 8, 9, 10, 11, whatever, depending on your investment platform.
And I want to bring up a shiny key for the
love it.
wrapping it all together here. Client of mine followed my advice, and they actually paid their house off in 7 years, which is unbelievable. And what they did was they put less money down. They had their other money working. Unbeknownst to me, he didn't really say that in the beginning. He didn't open up to me where all the places he had money, but one was Bitcoin.
No way.
So he cashed in Bitcoin as it kept going up and up and up, and he kept cashing in and putting it towards the principal. That's how he paid off his house in 7 years. And Bitcoin is actually, some lenders are now allowing Bitcoin as part of your down payment, as part of your cash that you can have to bring to closing, which is very complicated actually on the back end for us to it's not as easy as it sounds.
There is a home that was bought in California, 100% with Bitcoin.
You're going to see more of this happening, but I'm just saying there are some ways where he at first was very skeptical about not putting that money down, because he looked at the 30-year horizon of how much he was going to pay.
But it worked.
Because really you're paying triple. So if you're buying a $300,000 house in 30 years, you've paid $900 for that house because of the interest. Right, so that's why I say I hate paying interest. You hate paying interest. The less you pay, the better. But there are cases where it makes sense if you really have that discipline.
Strategic, intentional.
Right, that discipline is the key word. Is what are you doing with that money? Is it going towards a vacation and your new shiny car, or is it actually going back in the house? Because if you don't have that discipline, I suggest you put 20% down. But if you do have that discipline, make your money work for you, make the extra payments, and you'd be better off in the long run. There you have it. What else? Do you have anything else to add?
Well, I mean, besides saying that it seems like we are habitually shifting into tangent gear, and I think that's okay. I think that's a new
fine.
part
It
of
makes it
our
more interesting.
podcast is
And I have
a
no idea
tangent
what
gear.
she's going to bring up. So, okay, what are you bringing up now?
Oh my gosh! But as far as down payments go, I mean, something that does grind my gear in regards to down payments is people not taking the time to be their own advocate, and that is what you see through all the different channels about popular channels
Yeah.
for real estate information. It does not apply to all 50 states.
Or to everybody in this country.
Or
Everybody's
to every
different.
single person in
Everybody's
this country.
different.
And so I guess it hurts me when you hurt yourself by not deep diving and finding real valid information that applies to you, unique, wonderful you's situation.
And that's really why I don't have clear-cut answers a lot of times in these podcasts, is because it depends. And I hate saying that because it's kind of a cliche.
Crappy answer, Mark.
But it is reality. There are no two transactions that are the same.
No.
On the real estate side or the finance side, your situation is very unique to you. Okay, you buying a house with Bess is going to be a very unique situation where Bess is learning something along the way every time, and I do the same because every finance transaction is different. So there's no one size fits all. So be careful with advice out there that's one size fits all, because it's very personalized. Just like buying a house is hyper local, you can't go by what the news says about Dallas real estate market. It's really hyper local. Right.
The very buzzy right now, 30,000 level view, that phrase we've all heard.
Right.
A lot. That's really the best mindset when you are looking at these popular real estate information channels.
Generic information.
Right. Be it the one that starts with a Z or the one that starts with an H or all the alphabet in between.
Yes.
All that was backwards.
There you have it. Down payment wrapped up in 20 minutes. So there's a lot more to it. So we can have a conversation a lot longer about it. But anyway. Hope that helped you. Drop us a line down below, comment, let us know what you want to hear about.
If it was helpful, subscribe, and then you'll get notification of when we're going to be dropping
exactly
one
right.
again next time.
Send us
right?
an email, keysandgears@gmail.com. If you have any detailed questions, we'd love to answer them. And we look forward to seeing you next time.
We're always glad to have you, and we're always here to help.